Chapter 8, Question 11a. Alright, so in this question we have two different companies, ABC and XYZ, for the 2019 fiscal year. At the end of the discussion I will pop up the typed responses. Right now we were told the values of inventory as of December 31st, 2018 and 19, and the cost of goods sold for the year of 2019. We're asked to calculate a few things and compare the two companies. The first step is to calculate the inventory turnover ratio and days sales and inventory for the ABC company. Inventory turnover ratio would be your cost of goods sold divided by your average inventory. So for the company of ABC, we have the cost of goods sold of $1,452.50. Our average inventory would be 108.5 plus 169.7 million divided by 2. So for this inventory turnover ratio, we will have a rate of 10.4 for the ABC company. For XYZ, we want to do the same calculation. So for XYZ, we have cost of goods sold of 1432. We have inventory of 209.6 and 221.7. So we have an inventory turnover ratio of 6.6. The secondary part of question A and B are to determine the days, sales, and inventory, which you take the total number of days in the year being 365 divided by the inventory turnover ratio. So for ABC, you have a days sale inventory of about 35 days and about 55 days for XYZ. Question C says compare the results of these two companies. What conclusions can you draw? What we can indicate by this is that the inventory turnover ratio is higher for ABC, which is more desirable, which means they have fewer or less of their assets tied up in inventory. XYZ company takes 20 more days to turn over its inventory compared to ABC, 55 versus 35. However, we do not know if the two companies are in the same industry. Therefore, we really should not draw a conclusion for comparativeness. D says assume the two companies are in the same industry and competing for a contract for financing from private investors. Management, the ABC company, are aware of an error in calculating the value of cost of goods sold. If correct, it would have resulted in inventory turnover of 4.8 instead of 10.4. Management was aware of the error. If reported or not corrected, the investors may conclude that ABC does a better job of moving inventory than XYZ. However, if corrected, the investor may change their opinion and favor XYZ over ABC. As a manager for ABC, discuss the ethical implications related to reporting inventory. In this situation, management is always, actually in any situation, they're always responsible for reporting and correcting any errors at all for their organization, and in this situation specifically related to inventory. And failure to do so would be unethical. They're providing inaccurate information to their lenders and to the external community. The next slide, I will put up a copy of the responses, and I hope this helped.